Hey, my name is John Stevenson, and welcome to the Guaranteed Retirement Guy Show. So today we're going to be talking about how to create steady income for life in your retirement. So there are many ways to create steady income. One of the things that I focus on mainly are annuity contracts to do that. But you can do it through real estate. You can do it through bonds, municipals or corporate bonds. You could do it through dividend, stock dividends work as well. There's a lot of ways to create steady income. And most people, when they call me, they want income for life. They want to make sure that it's contractual. They're looking for something that's more passive. Even if you have real estate, I have people that will sell their real estate because they just are tired of being landlords and they just don't want to deal with it. They want to travel, they want to enjoy their family, and they just don't want to think about it anymore. And there are, that's valuable in my opinion. So it's always, there's a time for growth and there's a time for enjoying that and turning it into steady income. And so I'm going to show you how you can do that with annuity contracts. I know there's other ways to do it. It's just, I think the reason that people want annuities more often than not is because they're kind of done. They're done with the growth years. They're done with work, and they don't want to sit there and watch the market every day. They don't want to sit there and monitor their investments. They don't want to have to worry about if their AC goes out on one of their rentals and where they have to, pay another $20,000 in expenses that they weren't planning on. Okay, so there's a lot of great things that you can do with annuity contracts that will provide you that steady income for your retirement without the hassle, without the headache. Okay, so I'm going to share my screen. I'm going to show you some options that you have because there's a few. You've got SPIAs. SPIAs and DIAs will pay you lifetime income. Okay, you've got income riders, which pay you usually the most annual income per year, and they're more flexible as far as when you turn on payout times. And you got MYGA contracts. MYGAs are like CDs, and people will purchase MYGAs and they'll live off the interest, and then they'll just roll it over into another MYGA, and they'll continue to do that. You just have to realize that the income will be steady for that period, but then it'll be steady for another period at a different rate. And so if rates go down, then your income will go down as well. And so that is the one thing that people, a lot of times, if your portfolio is not set up to give you enough income, or if it's not large enough, then usually an income rider is the best way to go if you're looking for highest income that will never go down. Okay. All right. So I'm going to share my screen and we're going to look at a fictional client from Florida. 62 and 63, they're married, they got $500,000, and we're going to look at options for them to take income now versus later. So if they took income now, it's not going to be as much because you're giving it to the insurance company and they're giving you a guaranteed payout based off your ages, but you didn't give them enough time to have that growth to give you higher contractual income. So you have to remember that whenever you purchase immediate income, it's always going to be less because you're taking it right then. And so there's benefits to doing that, but you just have to realize if you want more income, you have to put more premium in. Okay. All right. So $500,000, 62 and 63. You can see all the options. There's a lot of options out there. And I work with all these companies. Gillico is a great company. They're guaranteed income life insurance company, and they are the highest payout, $33,500. But Corbridge is right behind them, and they're 100 years old. They're A-rated. So A and A-, very close, but a little bit higher rating and definitely older company. I would say if you're going to pick either one of these, pick at least Corbridge. Okay, because $33,250 is pretty much almost the same. I mean, the difference is $20 less a month. Okay, you got F&G, they're about 60, 70 years old. You got Prudential, you've got Meritas, they're another 100-year-old company. Athene's 100 years old, so is Allianz, the largest in the world. So there's a lot of great options, and they're all pretty close together. So if I was to pick either of these, if for an immediate payout, I would say Corbridge would probably be your best option. Okay, now, if I were to, again, just kind of remember these numbers because we're going to compare this to a SPIA and a DIA next, okay? So if I were to, I don't know, let's say I bought this, but I don't want to take income now. Maybe I want to take income in 5 years at age 67. You might be thinking, I would like to wait till my full retirement age, which might be 67, to take your Social Security. So you have a higher payout in Social Security. And of course, your same $500,000 is going to give you a higher payout for an annuity, for lifetime income. All right. So if I look at that, Corbridge right on top there, they'll give you $52,000. quite a bit more, right? That went from 33 to 52. So that's another $19,000 in additional income just because you let it sit and grow. So that's the power in deferral. Okay. And I'll show you how this works. Since this is an income rider, income riders attached to fixed index annuities provide a guaranteed growth rate for income. They're not legacy products. They don't, I mean, if you die early, there's, your beneficiaries will get whatever cash is in there, plus the earnings, but they are mainly income products, not growth products. Okay, so if we look at, you can see the guaranteed values are showing worst case scenario if the market does not do anything. They give you some of the index, which in this case is the S&P 500. They don't give you all of it, but they give you some of it. And then in return, when the market's down, you don't participate in any of the losses. Okay. All right. So you can see the income is guaranteed. That's what's important. That's why you're buying this. And then you can see the hypothetical. Again, the income's same guarantee. The only difference is they're showing you, here's what it'll look like if the index gets modest growth. Your account balance will last a few years longer. But that's it, okay? You can see the death benefit, same thing. Death benefit's there. You definitely have access to your money, but you're leveraging it for a high guaranteed pension for life. And what they're doing is they're taking a benefit base. This is why you get the income rider. The income rider gives you a guaranteed growth rate. And you can see this one's pretty high. It's almost, 10%? So if you look at this, it's 542 at the end of the first year, and then goes all the way up to 712,000, multiplied by a withdrawal rate of 7.3, much higher than your safe withdrawal rate, and that's guaranteed for life. Okay, and of course it is a income product, so the account value will run out, but by the time you're 95, 96, you've taken out 1.5 million. You take it out longer, you're going to take out more. Okay, that's how these work. So that's really, really nice. And I highly recommend these if you're looking for highest income, especially if you're going to defer it out. So 33,000 versus 52,000, that's a pretty big difference, but that's totally up to you. Otherwise, if you take immediate and you want more income, you just need to put more premium in. Okay. All right. So now that we have these numbers, let's go over and look at SPIAs. Let's compare. All right. Same 500,000. We're going to say joint life. We're going to go over here and we'll say income starts right now. So monthly income is from New York Life, $2,783 times 12, $33,396. So you are neck and neck with Corebridge for an immediate payout. That's not bad. Now, what you have to remember though is this is irrevocable. You cannot change this. Whereas with an income rider, if you turn on income, you can turn it off. If you want to surrender your contract value for the cash that's in there, you can do that. Okay, there are things that you can do with an income rider because it's attached to a fixed index annuity which is a liquid product. Okay, with a SPIA, they are not liquid. Okay, they're not liquid. You give the money to the insurance company and you have a guaranteed payout for life. That is it. Okay, now. You can do a refund option, which I always recommend because you want to make sure that if something happens to you and your spouse, that at least the money that you didn't use goes back to your beneficiary. So if I did this cash refund, that's really a more proper comparison to the income rider. So $2,751 per month for life. That's $33,012. So it's like went down $300 per year. So that's not bad. A little bit less than the income rider. And it's still with a great company. This one, in this case, is with Integrity Life Insurance. And you'll notice that New York Life is just a hair underneath them. Okay. All right. So now let's go back and let's say we want to defer this out. Okay. Let's take the same 5 years. We'll say we'll defer it out just as long as the income rider. The income rider, of course, was paying us $52,000 a year. All right, so Global Atlantic, they're the best one for that. What is that? 3713 times 12. The payout is $44,556. So the difference roughly is $8,000 less per year in lifetime income because you chose a DIA, which again, DIA is the same as a DIA. It has no cash value. It's irrevocable. You can't change the dates usually, and if you do, you're very limited. And that's really, it is what you see is what you get. So they're not flexible. You can't cancel them. You can't turn them off. You can't take the cash out. There is no cash value. And so there are, people ask, well, why would I ever want to buy these, John? Well, there are reasons to buy them. Okay. You might want like a period certain. Okay, period certain is great especially if you're not married, or if you have like a child you want to leave the income stream to, you can do that. So I can say, I can go up here and say, all right, well, I want joint life and I want to do a certain period of 30 years. So if me and my spouse both die, that income will continue to a beneficiary of my choosing, any beneficiary. Okay, could be a non-spouse, such as a child, a charity, doesn't matter. Could be a friend. So if we look at the same DIA, just compare that one real quick. You'll see it's a little less. Okay, Massachusetts is the best at $33.64 a month and is guaranteed for life, for a joint life. Plus, if you and your spouse both die before the 30 years is over, it will continue to pay out of a beneficiary of your choice. Okay. All right. And the same goes with a SPIA as well. So it's just a little bit less. All right. So one other thing you can do is you can get a MYGA. And MYGAs are like CDs. Okay. Except for non-qualified money, they grow tax deferred, which is pretty nice. So if you look at this and say, well, I want to take income for 5 years, then you can see the top payouts here. It's like 5.6. So that's pretty easy. We know based off of that. Like SBLI, they're based out of Massachusetts. They're a solid company. But they only allow you up to 5%. If you want to be able to get all of it, then Exonic is the best option. So we can look at this and say, all right, well, I get a 5.55. What does that look like? Here's what you're getting per year. $27,750 per year, guaranteed for 5 years. That's if you strip off the interest. If you don't strip it off, then it's going to compound. As you can see, it compounds to $155,000. The ending account value is $655,000. So pretty good. People will buy these for legacy products, or they'll buy them just to live off the interest and they want to leave the principal behind, or they want to roll it over into another contract. You just have to remember that is not guaranteed for life. And that is why usually people will buy these and the income products so that their income is covered plus their legacy or their growth. Just have a little bit more flexibility with the MYGAs. That's what you do them for. Okay, now let me just look one more thing. I just want to see 7 years. Yeah, still 5. Yeah, that's a pretty good rate. Let's see, 10 years, Heartland National. And I could say, well, I don't want to do, and there are some B++ companies I do recommend. Heartland National is one of them. But if you don't want to do that, you don't have to. Okay, I can go up here and say, well, I want to do an A or higher for all of these terms. Okay, well now it's going to show me the best for that. So now if I go down to the 10 years, Royal Neighbors is great. And they are good. They're not a huge company. They got like $1 billion in assets, but they're a solid company. And so a 5.45, that's not bad. So they give you interest only. Okay, great. So at least I'm locked in for 10 years. At least I know it's not going to go down over 10 years. And so from that, it's roughly the same amount. It's $27,250 per year, and you can take that every single year. And at the end of that 10 years, take your $500,000 out and put it in something else. So if you're thinking, I'd like to put this into a lifetime income product later on, like an income rider at the end of 10 years, then I would highly urge you not to do that, because you can get more income from an income rider right now. As you can see, immediate income based off an income rider is $33,000. Okay, you can do that right away and take, you're taking $6,000 more a year. And that's right from the get-go. Or if you wanted to wait 10 years with the same money and just let it sit and grow, and you're thinking, hey, I'll just take $850,000 here because that's what it's going to compound, and I'm going to just take an income rider. The issue is that income rider value will be much more than $850,000 if you were to put it into that contract and let it sit and grow for 10 years and then take income. So you take that $850 and it'll give you immediate income at 10 years, but it's not going to be as much. And so that's what you have to remember. It depends on your long-term goals with that money. And that will depend on the recommendations I make. You can do whatever you want, but that's what I would recommend. So I'll push this out and I'll show you what I mean. If I push this out 10 years, this is an income rider, same $500,000. So let's say you're thinking, I'll just put the $500,000 in the MYGA, let it sit and compound to $850,000, and then I'll put it into an income product versus this. Well, the income rider, look at the guaranteed income from this. You think you're going to get that from $850,000? Probably not. So let's say we want to stick with A+, $76,550. That's pretty darn good. Okay, so if I go in here and I look at that, I'll just let me just show you a different one. We looked at Midland already. Let's look at their sister company, North American. So if we look at the illustration here, we'll say $75,000 a year. This is what I mean. See, the benefit base grows to like $1,079,000. Okay, then you got 7%. So 7% multiplied by 1,079,000 gives you 75,562 per year, guaranteed for the rest of your life. You see what I mean? You could take that 850,000 out, absolutely, from the MYGA, and you can put it into a guaranteed income product for life. But the problem is 850,000 multiplied by 7% is 59,500. So the problem is if your sole purpose is to take income later on, the MYGA was a terrible choice. Okay, but if your sole purpose is to take income and not to use it for legacy, then an income rider, as you can see, will give you 75,000 versus 59,000. That's a huge, huge difference in income. And that's all because you decided to put it in the correct contract right from the beginning based off of your long-term goals later on. Make sense? All right. So if you want to book a call, there's a link below the video. You can also go to my website, johnstevenson.com, and you'll be able to book a call with me there. You can also look at the annuities on the annuity calculators as well, and it'll show you everything that's available from all the companies. So anyways, I'm pretty transparent. I like to show everything, even if my commissions are lower on some of these products, which they are. It's better for you to at least see what's available so that you can make the proper decision and not be pushed an annuity product by an advisor who's going to be paid very, very well, very high commissions, and maybe get a trip incentive. And so a lot of times they will be biased on certain products or certain companies because of that reason, which I get it. The temptation is there. But for me, transparency is really, really important. So that's why I have everything on my website so you can look for yourself. And then when you book a call with me, I'm not going to just throw out some surprises because I have the same data in front of me as you do as well. So I hope that makes sense. If you like the video, make sure you like, subscribe, share it, and comment if you like. I'd love to answer your questions. And again, if you're looking to purchase an annuity, I'd love to help you. So again, thanks for watching, and we'll see you next time.